Hello, everybody. I'm recording this lecture on December 26th, 2021. I hope everybody is fine. I'm now going to start with the first lecture in Module 5, which covers the sourcing of gross income. And this is covered in your book in paragraph 73 or chapter 73. We're focusing now on the sourcing of gross income and not the allocation and apportionment of expenses against gross income. Why is this subject important? And Professor Loken covers that in his introduction in 73.1. Let's go through that. By the way, this is the first of a few lectures that's going to be covering sourcing of income. There's just a lot of material, and I can't do it in one or even two lectures. So in 73.1, in the introductory, Professor Loken writes, many statutory provisions affecting the taxation of foreign income and foreign persons distinguish between income from sources within the United States and income from sources outside the United States. For example, the withholding tax imposed by sections 871, A1, 881A applies to various items of non-business income of non-resident alien individuals and foreign corporations, but only if the income is from US sources. And we discussed that earlier in the semester, if you recall. So this withholding tax on items like interest, dividends, rents, and royalties under 871 and 881 only apply to US source income. So the income is foreign source. These sections have no application, and there's no US withholding tax. He goes on to write, a non-resident alien or foreign corporation engaged in trade or business in the United States is taxed under section 1, dealing with individual tax, or 11, dealing with corporate tax, on income effectively connected with this trade or business. And the rules identifying items effectively connected income distinguish between income from sources within and outside the United States. Let me interject that most, as we covered earlier in the semester, most but not all effectively connected income is US source income. So sourcing is important in that regard too. He goes on to write, this is Professor Loken in your textbook in 73.1, first paragraph. A US citizen or resident or domestic corporation is entitled to credit against US tax for foreign income taxes, but the credit may not exceed pre-credit US tax on taxable income from foreign sources. This is section 904 that I mentioned earlier in the semester. I'll come back to when we talk about foreign tax credits. Everybody said a U.S. corporation, generally will not be able to obtain credits that exceed the current tax rate is 21% times net foreign source income. And the starting point for net foreign source income is gross foreign source income. So determining whether something is US source or foreign source can be exceptionally important in terms of being able to use foreign tax credits. And the next last sentence in the first paragraph of 73.1 deals with section 911, which we discussed earlier in the semester. Professor Loken writes, section 911 exempts from tax certain foreign sources earned income of US citizens who are bona fide residents of foreign countries. So the 911 benefit is predicated on having foreign sourced and the income being earned income. So that's another important reason why we study whether income is foreign source or US source. Let's go through Professor Loken's introduction. I'm going to now go to the 73.1 second paragraph. Before we go through it, I want to point out something that's really important. At least as I'm recording this lecture on December 26, 2021, the third paragraph in 73.1 is incorrect. It doesn't reflect changes made by the Tax Cuts and Jobs Act enacted in December 2017 that deals with the sourcing of inventory sales, where the taxpayer is both the producer of the inventory and the seller of the inventory. Let's go to the second paragraph, though, of 73.1. Pardon me for a second. Section 861 through 865 clarify various types of income by source. Before I go on, let me mention this now because it's an important point. 861A, 861 list, not just A, 861 lists various sources of U.S. source income. Its counterpart is 862, which basically says if it's not listed in 861, then it's not U.S. source income. It comes within 862. There are some exceptions, but that's the way the code is drafted. So in the second paragraph, Loken writes, and we're going to go through these rules in more depth as the lectures continue. Section 861 through 865 classify various types of income by sources. Interest income is usually from U.S. sources. If the debtor is a domestic corporation or a non-corporate resident and is from foreign sources, the debtor is a non-resident or foreign corporation. And we'll go through the interest rules shortly. Dividends from domestic corporations are from domestic sources, whereas dividends from foreign corporations are usually from foreign sources. And again, we'll do that in depth, I believe, in the next lecture. Income from the performance of personal services usually has its source where the services are performed. Rents and royalties are from sources within the country in which the lessee or licensee uses the property that is the subject of the lease or license. Gain on disposition of U.S. real property interest is from U.S. sources, and gain on the sale or exchange of real property located outside the United States is from foreign sources. Let's turn to the third paragraph, which, as I said, needs to be rewritten. For some reason, at this writing, Professor Loken has not revised it to take into consideration the fact that the Tax Cuts and Jobs Act made important changes. So in the third paragraph, Professor Loken writes, income on the sales of goods manufactured by taxpayer is bifurcated between the manufacturing and selling expenses of the taxpayer's business. These first two sentences are just incorrect. Pursuant to changes made to 863B by the Tax Cuts and Jobs Act, where the taxpayer is engaged in both both producing and selling the inventory, sourcing is based on place of production. That is, where are the tangible tangible and intangible assets used in producing the inventory located. So it's not split between place of production and sale. It's entirely sourced based on production, and we'll go through those rules later in the course, or later, in a later lecture. So again, just be careful with that third paragraph because it's out of date. After he talks about the split sourcing, which is not correct, he correctly points out, and again, I'm in the third paragraph of 73.1. I think I'm in the third sentence. Income on the sales of goods acquired by purchase and held for sales to customers in the ordinary course of business is entirely allocated to place of sale. And that is correct. That continues to be the law today. Again, this would apply to a distributor or retailer who doesn't do any manufacturing or production or the like with respect to the inventory. He concludes that third paragraph saying, A sale is usually deemed to occur where the title passes from seller to buyer. And we'll come back to that. In the fourth paragraph of 73.1, Professor Loken writes, gains on sales of personal property not held for sale in the ordinary course of business are usually from sources in taxpayers' country of residence. There are special rules that we'll be discussing as to what is country of residence. And for an individual, these differ from what we learned in 7701B. Special rules exist in 865G, just covering 865, dealing with residence for purposes of section 865. And we'll come back to that. He goes on to write, for example, gains recognized by a U.S. resident on sales of stocks and securities held for investment are from domestic sources, regardless of where the sale occurs or where the issuer of the securities is organized or does business. If a U.S. resident speculates in stocks listed on the Hong Kong Stock Exchange, gains from these trades are from U.S. sources. The next point that I want to cover is the fact that sometimes it's difficult to determine what the activity is. Often this comes up in situations where something could be characterized as either the licensing of property, usually intangible property, or the performance of services. And this brings us to a case that I think I may have mentioned in the context of section 911, a case called Ingram v. Bowers. Ingram v. Bowers, you can check the, it's referenced in chapter 73 in your book. In Ingram v. Bowers concerns the very famous early 20th century Italian opera singer Enrico Caruso. Under a 1911 agreement with the Victor Company, Caruso recorded several songs in the company's studio in New Jersey, United States of America. On the face of the contract, Caruso was undertaking simply to sing songs which the Victor Company would record. By the way, we'll come back to this, but if something is characterized as a service, then you look to where the service is conducted to determine sources. So if this were viewed, and it was viewed, as a performance of a service, and it's done in the United States, then it would be entirely U.S. source income and therefore taxed by the United States. Victor made a master recording and then made copies of that recording of Caruso singing. Caruso was to receive a royalty from the sale of each individual record by the Victor Corporation. The songs, I said, were all recorded at the Victor Company studios in New Jersey, United States of America. The predecessor to the IRS, the Revenue Service, accordingly took the view that Caruso had received compensation for personal services performed in the United States in an amount reflecting the value of those services to the employer. So viewed, Caruso's entire income from the arrangement was U.S. source compensation, including contingent amounts received later from sales of records outside the United States. Caruso's estate, and he had died before the case was litigated, sought in contrast to characterize the transaction as the license by Caruso to the Victor Company of rights in the recorded songs for use throughout the world. This character, for royalties, you look to where the license is being used. So if records were sold in the United States, it would continue to be U.S. source. But to the extent that the recordings were sold outside the United States, had Caruso's estate prevailed, that is, that this were viewed as a license of property, then with respect to sales of records occurring outside the United States, records, you may not be familiar with the term, but it's the predecessor to like discs that we have today. I think there are still some records around, but the key here is that if it were in fact viewed as the license of intellectual property, to the extent the recordings were sold outside the United States, they would be foreign source and not subject to U.S. taxation to a foreign national like Caruso. But they weren't. They were held to be the performance of services. And so all of it was subject to U.S. taxation. The district court, the lower court, district court, found the overall transactions to be, in essence, the performance of services. Caruso had agreed to sing and had been compensated for singing, and therefore the place where the work was done and not the place where the later event fixing the compensation occurs is a source of the income. In cases where the income is from the exercise of a profession or vocation, as in this case. On appeal, this holding was affirmed by the Second Circuit, and the court again held that Caruso was performing services. And therefore, since it was done in the United States, it was all U.S. source, and it would be, and Caruso would be subject to U.S. taxation. The court said Caruso had no interest in intellectual property, in matrices and records themselves, nor any rights to the copyright. He didn't retain any intellectual property, so this can't be viewed as a sourcing I'm sorry, the licensing of intellectual property. There being no interest in intellectual property to be licensed, the characterization of license would not stand up. Ingram v. Bowers is an important case in several respects, not the least being that it reveals a method commonly followed by the U.S. courts in resolving tax questions. In Ingram, the Court of Appeals first attempt to lay bare the legal and contractual relations that existed between Caruso and the Victor Company, and then allows the tax consequences to be governed by the legal categories so delineated. If you represented a client today, a foreign national, how would you attempt to limit or avoid U.S. taxation? Well, if you had a foreign national, what you would do is you would record the music outside the United States. You would not retain any intellectual property rights to the recording. So this has to be viewed as the provision of services. Since it's done outside the United States, it therefore is foreign source and not subject to U.S. taxation. And in fact, today, it's been reported that a number of foreign popular music stars sing their recordings in some low-tax foreign environment, such as the Bahamas, under an arrangement followed by Caruso and the Victor Company. They will earn no U.S. source income under the doctrine of Ingram v. Bowers, even though all recordings might ultimately be sold in the United States, because it's not being viewed as a license of property. It's being viewed as the provision of services being done outside the United States. It's foreign source, not taxed in the United States. If that's not clear to you, please email me. We can talk about it. I've asked you to read and brief a case called Boulay v. Commissioner. Boulay is sort of a more modern day version, I believe, of Ingram v. Bowers. It's cited in your book. It's 83 Tax Court, 584 in 1984. I did upload the case on the class's website. the taxpayer here, Mr. Boulay, who died in the last couple of years, was an orchestra conductor who received royalties for performing a recording in CBS for CBS records in the United States. So the recording was done in the United States, and the court essentially held that the income was sourced based on where the services, the recordings, were conducted. In this case, it was done in the United States. It was U.S. source income, and not the licensing of intellectual property. So, and again, it was just like Ingram v. Bowers. Boulay was a French national, a West German resident. This is all before your time, but Germany used to be divided between Western West Germany and communist East Germany. This was all before 1989. There was a separate U.S. West German tax treaty. Under that treaty, since Boulay was a West German resident, had this been viewed as the license of intellectual property, there would be no U.S. tax even on sales within the United States, because the treaty would preempt the code provision. And that's what Boulay argued. Boulay argued this is the license of intellectual property because he wanted to come within this West German treaty. The IRS disagreed with that. The case actually went to competent authority under the tax treaty, this mutual agreement procedure to determine or try to get the parties to agree as to whether this was in fact the provision of services or the licensing of intellectual property. They could not agree. There was no binding arbitration in the West German U.S. tax treaty. So, the competent authority relief was just not available because the U.S. and West German governments took different views. So this was decided under pure U.S. law. And the court, as I said, held this was the provision of services. The court said that they had to really answer two questions, which I have a different. You look, when you go through it, you'll see it's on page 6 of my version of it. But the font in your version may be different than mine. But the two questions that the court said it had to answer was, did petitioner, Mr. Boulay, intend and purport to license or convey to CBS Records? And did the latter agree to pay for the property interest in the recordings he was engaged to make, which would give rise to royalties? And the second question, and they answered that question no, by the way, that he didn't, that was not what the parties intended. And the second question was, did petitioner, the taxpayer, Mr. Boulay, have a property interest in the recordings, which he was capable of licensing? Did he retain a copyright? And they said no. And I think the reason that they broke it down or answered the second question, even though the first question was negative, was because they were concerned they might be reversed on the first question on appeals. That never came to be. The court indicated that considered as a whole, while therefore acknowledging that the contract was not perfectly clear, we conclude that the weight of the evidence is that the parties intended a contract for personal services rather than one involving the sale or license of any property right, which petitioner might have in the recordings. They also concluded that Mr. Boulay did not retain any intellectual property rights under, he didn't, just under U.S. law, he doesn't have any intellectual property rights to retain. As I asked you to brief the case, please read it and brief the case. That's your assignment, one of your assignments for Module 5. Again, if you have any questions, please feel free to email me. Okay, let's discuss now the sourcing of interest income. This is covered in your book in 73.2. As a general rule, interest paid by individuals takes its source from their place of residence of the debtor, the borrower, while interest paid by corporations has its source in general in its place of incorporation. So a U.S. corporation would generally pay U.S. source income. In 73.2, first paragraph, Professor Loken notes that interest income is from U.S. sources if it is paid or accrues on obligation of a domestic corporation, a non-corporate resident of the United States, the federal government, or an agency or instrumentality of the federal government. Interest on obligations of foreign governments and non-residents, including U.S. citizens residing abroad, and foreign corporations, is usually from foreign sources. That would be 862A1. 861A1 deals with U.S. sourcing. There are some exceptions. Under 861A1, interest paid by individuals has its source in the individual's place of residence. This rule doubtless reflects the broad expectation that a borrower is most likely to put borrowed money to work where he resides and pay the interest out of funds available at that place. As Loken points out, I think I'm in 73.2, first paragraph, third sentence. It is not relevant where the interest is paid, where the evidence of the indebtedness is situated, and where the transaction giving rise to the debt occurred. You look to the residence or place of incorporation of the debtor. One writer notes the rule tying the source of interest to the residence of the individual who pays it is more easily stated than applied. The residence of individual borrower is largely a factual matter and may not be readily apparent to the lender of money whose dealings with the borrower are limited. A further difficulty is that the residence of individuals may change during the period of payment or accrual of interest on the debt obligations. In terms of what is the relevant time for determining the residence of an obligor, the general rule is that you look to the residence of the individual debtor at the time the interest is paid. And that governs its source. So the key time is when it's paid or accrued, and that's set forth in Reg Section 1.861-2, little a in parenthetical, 2 in parenthetical. Let's just read, well, I'm sorry, next point. Let's talk about a guarantor. I'm not sure if you guys know what a guarantor is, but a guarantor is somebody who basically says that if the debtor can't pay, we will guarantee the indebtedness, both the principal and interest. So if somebody has bad credit, a lender will often require that there be a guarantee. Payment of interest by a guarantor is irrelevant in terms of sources. You don't look to the guarantor its or his or her residence is irrelevant. You look to the residence or place of incorporation of the underlying debtor. So Loken points out in 73.2, first paragraph, fourth sentence, in the case of guaranteed debt, the residence of the primary obligor is controlling. Even the guarantor pays the interest. It doesn't make any difference where the guarantor is resident. Again, you look to the primary obligor, except if the guarantor has become the primary debtor. And sometimes it's difficult to determine whether the guarantor has assumed the obligation or is still functioning just as a guarantor. If it's functioning just as a guarantor, its residence is irrelevant. You look to the residence or place of incorporation of the debtor, not the guarantor. As I said, let's focus on interest paid by corporations, which pay a lot more interest than individuals. In general, domestic corporation debtors, that is corporations that are incorporated in any state of the United States, District of Columbia, or the U.S. government, generally pay U.S. source income. There are exceptions to the general rule we'll be dealing with. The term interest includes not only interest on bonds, notes, and other interest-bearing obligations, but also original issue discount and unstated interest under Section 483. I think you guys have studied these sections, or at least original issue discount in an earlier course. If not, I wouldn't worry about it for this course. I want to address something now, dealing with a topic that we mentioned earlier. We talked about the fact that under 871 and 881, U.S. source interest is generally subject to withholding tax when paid to a foreign individual under 871, or under to a foreign corporation under Section 881. There are some important exemptions that don't change the sourcing, but they basically provide that if you fall within one of these exemptions, there'll be no U.S. withholding tax, which is what the foreign corporation or a foreign individual, is concerned about. Will there be withholding tax? So I want to focus on two of them. One I mentioned earlier, the portfolio interest exception, but the first one I wanted to talk about briefly is a provision that deals with interest income on U.S. bank deposits, deposits with domestic savings and loan associations, and amounts held by an insurance company under agreement to pay interest thereon. They are generally exempt from withholding tax of income of non-resident alien lenders. This is provided for by 871 little I in parenthetical, 2 in parenthetical, cap A in parenthetical, Section 871 little I in parenthetical, 3 in parenthetical, and Section 881 little d in parenthetical. This is covered in your book in 67.2.2.3 under the caption interest on deposits. Again, if you fit within these provisions, this bank deposit exception doesn't change the sourcing from U.S. to foreign, but it provides an exemption from the reach of 871, 881. So there is no 30% withholding tax. I mentioned earlier in the semester that separate and apart from statutory exceptions, under many tax treaties, the withholding on items like interest, dividends, rents, and royalties is either reduced or in some cases nullified completely by virtue of a tax treaty. This exception for bank deposits does not apply in a case where, let me get my notes in front of me, does not apply if the interest income is effectively connected with a U.S. business of the lender. So that's an out. It's discussed in your book. You just have to be aware of it. You know, the bank deposit exception can be important if the portfolio interest exception doesn't apply because the lender and the debtor are considered to be related parties. Let's go back to something I mentioned earlier, which is with this portfolio interest exception. And the portfolio interest exception is covered in your book in 67, 2.2.2. You know, essentially, most interest on debt that is in registered form, you know, where the IRS knows, you know, who the, you know, knows the parties. It's not in bearer form. Then, you know, if the parties are not related, as specifically defined, there's an exception for FDAP withholding. So your text notes in 67, 2.2.2 under the caption bank loans, that interest income of foreign bank cannot qualify for the port. Oh, I'm sorry. Before we go to the portfolio interest, I want to point something out. 67, 2.2.2 under the caption bank loans, the interest income of a foreign bank cannot qualify for the portfolio interest exemption if it is received on extension of credit made pursuant to a loan agreement entered into in the ordinary course of a trade or business, and the borrower is any person other than the U.S. government. That's really the exception that I was talking about earlier. Okay, so all I want you to know is that the bank deposit and the portfolio interest are two important exceptions to FDAP withholding under 871, 881. Let's just cover guarantee fees, which is the sourcing of guarantee fees, which is covered in your book in 73 point, I believe it's 9. Let me just get in front of me for a second. No, I'm sorry. It's 73.6 guarantee fees. Let's read that section. This is the sourcing of guarantee fees, which we'll see is sourced very similar to interest. The tax court in 2010, so I'm reading from 73.6, the tax court in 2010 held that fees received for guaranteeing debt of another person are most analogous to income from services, not interest, and that the fee income is thus not from U.S. sources if the recipient of the fees is not a U.S. person. Either the payer of the fees and the obligor of the guaranteed debt is a U.S. person. This is a case called Container Corp versus Commissioner, cited in your book. Very importantly, the next sentence points out this was reversed. Congress in 2010 enacted Section 861A9, which reverses prospectively the Container Corp decision. So I'm reading now, I'm back in 73.2.6. Professor Loken in the second sentence writes, Congress promptly overturned this holding by adding a provision stating that an amount received for the provision of a guarantee of any indebtedness is income from U.S. sources if it is received from a domestic corporation or a non-corporate resident of the United States, and the payment for guaranteeing indebtedness of that person. An amount received from a foreign person for a provision of a guarantee of any indebtedness of such person is also from U.S. sources. It is connected with interest of the foreign person as effectively connected or treated as effectively connected with the conduct of a trade or business in the United States. In other words, a guarantee fee received from a foreign person is from U.S. sources. If the foreign person is engaged in the U.S. trade or business or deemed to be so engaged, any deduction allowed to the person for the fee is allocated on the person's income effectively connected with the U.S. trade or business. A guarantee fee received from a foreign person in any other circumstance is income from foreign sources. Let me give you an example. I believe, by the way, E&Y India prepares the federal tax return for my former company, Unilever United States, which I retired from in 2011. Let me give you an example. It's a bogus example, at least when I was there. If the Unilever United States paid a guarantee fee to its foreign parent, Unilever PLC, it would be considered to be U.S. source because the payor is a U.S. company. At least when I was there, we didn't pay anything. It was done through a cost-sharing agreement, although that may have changed 10 years since I left. I want to turn to a provision covered in your book in 73.2.1. It deals with the 80-20 rules. And let me set the stage before we go through it. The 80-20 rules were an exception to U.S. sourcing under certain circumstances. They were repealed in 2010. So the question you might ask yourself is, why are we going to study a provision that was repealed in 2010, effective 2011? It's because there are two important grandfather provisions that can continue to apply, today. A grandfather provision permits you essentially to use old law under certain circumstances. Before we talk about the grandfather provisions, let's just go through what these 80-20 rules are. And I'm reading from 73.2.1. For taxable years beginning before 2011, interest on an obligation of a resident alien or domestic corporation, and I add the word generally here, is foreign source income if during a testing period at least 80% of the debtor's gross income was income from sources outside the United States derived in the active conduct of trade or business in a foreign country or U.S. possession. The testing period is usually the 3 taxable years of the debtor preceding the year in which the interest is paid. If the debtor existed for less than 3 years before the taxable year of the payment, the testing period is the term of its existence before the current year. If the payment is made during the debtor's first taxable year, that year is the testing period. If the debtor is a domestic corporation with one or more subsidiaries, income received by the corporation from the subsidiary's active foreign business income to the extent attributable to the subsidiary's active foreign business income. A dividend from a subsidiary's active foreign business income in the same proportions as subsidiaries' gross income is active business income. For example, if 60% of the subsidiary's gross income is active foreign business income, 60% of the dividend from the subsidiary is foreign active business income of the parent. Interest, rents, and royalties received from a subsidiary active foreign business income to the extent the subsidiary's deduction for the items are allocated to the subsidiary's active foreign business income. A corporation subsidiary for this purpose, if the debtor corporation owns at least 50% of its stock, both by value and by voting power. Let me interject before we go to the next paragraph. So if the foreign subsidiary, I'm sorry, the subsidiary, not foreign, if the subsidiary of the payor doesn't pay to the payor of the interest, dividends, rents, or royalties, then you ignore the subsidiary. You only count the subsidiary to the extent it makes payment to the taxpayer who's paying the interest. That's not clear. You can please email me. Let's turn to the last paragraph of the 80-20 rule. Normally, if at least 80% of the debtor's income is active foreign business income, all interest in the debtor's obligation is from foreign income. However, if an interest recipient is related to the debtor, interest is split between U.S. and foreign source in the same proportion as the debtor's gross income, the testing period. A debtor and interest recipient are related. Either of them is an entity that the other owns at least 10% of its stock or beneficial interest by voting power or by value, or two, both of them are entities and the same person would own at least 10% of their stock or beneficial interest. By the way, you need to come with the 80-20 rules, you need to have at least 80% active foreign. But in terms of bifurcating the interest paid to a related party between foreign and domestic, I think as long as you got 80% active foreign, even passive foreign counts. So in a situation where you had 80% active foreign, 10% foreign source, interest paid to a related party, 90% would be considered to be foreign source. I want to talk about these two grandfather rules for 80-20 companies, which is the primary reason we study it. Now, the other reason I guess we should study it is because, I'm not sure whether you'll be involved in audits, but to the extent that you're involved in audits, it's possible that some tax returns have been extended and you'll be defending audits prior to 2011. And so the old rules will apply. But I think the main reason we study it is because of the grandfather rules. Under one grandfather rule, any domestic corporation that meets the 80-20 rule as an effect before the enactment of this provision, that is the change in 2010, for its last taxable year, beginning before January 1st, 2011, two, meets a new 80-20 test with respect to each taxable year beginning after December 31st, 2010, and three, has not added a substantial line of business with respect to such corporation at the date of the enactment of this provision. If you meet all of these requirements, that under this first grandfather rule, while the sourcing continues to be non-US source. This provides an exception to withholding, um, which can be, very important because it nullifies the 30% for DAP withholding. The second grandfather rule essentially applies as follows. The repeal of the 80-20 company provisions relating to the payment of interest does not apply under the second grandfather rule to payments of interest to persons not related to the 80-20 company on obligations issued before the date of enactment. And let me add, that have not been substantially modified. So if you had a substantial modification, like you extended the term, say it was at a 5-year term and you made it a 50-year term, you would not come within the second grandfather rule. But suppose that you had a debt obligation that ran, say, for 50 years. You didn't make a substantial modification to it. Then under the second grandfather rule, you're permitted to take advantage of the 80-20 rules, even though the years we're talking tax years after 2010. So this one actually changes the source from US to foreign. I wanted to now, let me go look at my notes for a second. I want to point out, we're looking now at 73.2.2. We're talking about interest paid by foreign banking branches. So as Loken points out, interest on deposits with domestic corporation or partnership is foreign source income if the deposits are with a foreign branch of a corporation or partnership, and the branch is engaged in the commercial banking business. For the purpose of this rule, it is not relevant where the corporation or partnership also carries on a banking business in the United States, whether the recipients of the interest is a US or foreign person, or whether the deposits are denominated in a foreign currency or US dollars. Conducting for US banks to conduct business in branch form is commonplace. And the reason for that is because lenders, want to have the assurance of their loans being guaranteed by the US bank parent company, not just a subsidiary. So often banking outside the United States is done as a branch of the US company. And this is sort of in keeping with what's done commercially. If a bank, say JP Morgan Chase, a US bank, say sets up a branch in the UK, even though it's a US debtor, it's still a US company, under the special rule in 861 little a1ai, under the special rule, the interest will be considered to be foreign source because it's paid by a foreign branch, a foreign banking branch. The next section I want to discuss, dealing with sourcing of interest, is part of the branch rules in 884F. I think I mentioned as part of the introduction, we talked briefly about the branch rules. Under section 884 F1A, interest paid by a trade or business conducted by a foreign corporation in the United States is treated as if it were paid by a domestic corporation. This is the effect in general of assigning U.S. source to interest paid by a branch of a foreign corporation engaged in business in the United States. The rule essentially treats U.S. business operations of foreign corporations as though they were separately incorporated in the United States. By assigning U.S. source to an interest paid by a U.S. branch business of the foreign corporation, the rule exposes to U.S. taxation, that is for DAP withholding, interest that is deductible in computing the income of a U.S. Business. So, they're giving you a deduction for interest expense, but by making this U.S. source, the branch of the foreign corporation is going to, in general, be subject to this 30% FDAP withholding under Section 881. Very importantly, however, under regulations under 884F, the normal statutory exemptions from U.S. tax, like the bank deposit rules and portfolio interest, will apply to the branch rule. Also, treaties may reduce or eliminate withholding tax on the U.S. branches paying of interest. Let's quickly read 73.2.3, first paragraph. Interest from foreign corporations, give you a brief overview of the branch rules dealing with interest. For periods after 1986, interest on obligations of foreign corporations is generally not from domestic sources. However, interest paid by U.S. trade or business of a foreign corporation is deemed paid by a domestic corporation and is therefore from source within the United States. Also, an interest deducted in determining income effectively connected with the U.S. trade or business exceeds the interest paid by a trade or business. The excess is treated as paid by a domestic corporation to the foreign corporation, creating a notional interest income from U.S. sources. Loken covers this area in detail in paragraph 67.8.3 if you're interested in the area. I just wanted to point out interest in partnerships is discussed in your book in 73.2.4. I'm not going to test you on it, but please read that on your own. Okay, I think I'll stop here. When we go to the second part of sourcing of interest, we'll start with notional principal contracts and interest rate collars, and then talk about dividends and services and see how far we get. Okay, have a good, this is an evening, have a very good evening, and we'll speak again. Take care, buddy. Bye.